Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny. And man, oh man, we got some PCE numbers this week. We're going to talk about what Jay Powell probably sees when he looks at these numbers and what curveball is going on in the world right now that completely destroys the utility of these damn numbers, even though we don't get them but once a month. It's
Oh,
just crazy times. I'll say that.
it is.
Crazy times.
One tweet,
So,
man.
headline number 2.1%, man. Do you remember what the Federal Reserve's goal is, Dylan?
2%.
Yeah.
I was very surprised by this because the Fed did not cut specifically because they were worried about inflationary tariff issues, but also they were not close to this. And then 1 month later, 2.1. So I'm waiting for you to tell me why we shouldn't trust this.
I mean, 2.1, that's like point 0.1 greater than 2. Okay. That's pretty damn close if you ask me.
You
And
heard that
I'm no
here.
mathematician or something, you know?
Two Stupid Guys Trade Stocks. 2.1 is point 0.1 more than 2. Take it to the bank.
Yes, exactly. And also mathematician, that's another
Mathematician.
great term there. So, all right. PCE, Powell's long talked about how this is his favored kind of inflation metric rather than CPI. This accounts for people adjusting and buying different products based upon the prices. If there's all of a sudden chicken's a lot cheaper than beef, maybe people will buy more chicken. PCE's designed to measure how much people are spending rather than like what the prices themselves are really doing on these
Right.
categories. And we've talked about for a while that we've had headline has crossed under and been under the core PCE. Core PCE being the best metric of all because it excludes food and energy, which tend to be more volatile items. But we do see we're really right at our 2% target effectively here now with the headline number of 2.1. That's where the Federal Reserve wanted to be. Now, the core PCE, the one like I said that matters more, is still a little bit higher, but we've had some significant progress over the last couple months this year because we got that little early spike this year. You know, yeah, on this graph, not very spiky, but still a little spiky.
I mean,
All right.
still.
As far as what's going on and why that happened, like I said, it was 2.1 for headline, 2.5 for core. This is interesting. So consumer spending slowed though for this past month, posting a 0.2% gain compared to I think it was 0.8% last month.
Okay.
So what do you think about the fact that people increased their spending by 25% of the rate that they had the month previously?
Wait, they increased their spending,
They still increased their spending. Consumer spending
but
still
it
went
was
up at
significantly lower.
0.2%
Right.
instead of 0.8. It was a
Okay.
quarter of the clip that it had been going up by previously.
I I read that, especially with the next line here, savings rate surged to 4.9% as everyone is scared of a market crash.
Okay. I don't know about a market crash per se as more
Economy
of
crash. Recession.
fiscal tightening,
Yeah.
household budget tightening. You're starting to see people be a little bit more reluctant and not as spendthrift with their funds. They're saving more, spending less effectively on a household basis, right? So, as far as like that consumer spending, like I mentioned, 0.2% increase had been 0.8 the month before. It was a 0.7% increase, is what economists were calling for. So, consumer spending increased at a much lower rate than had been expected by economists, and a much slower rate than the previous month. Right?
Okay.
So, good thing for inflation, right? And we did see savings rate go up more than a 0.5% in a month. 4.9%, still a pretty modest savings rate, if you will, but it has increased by if you're thinking about it from a percentage standpoint, this went up 10% on a month over month basis. So people definitely
Yeah.
putting more money towards savings.
To me, I read that as recession fear. But
Okay, I don't know if necessarily a recession here. It can become a self fulfilling prophecy, but I think the average American household in the last month has been more fiscally conservative, if you will. So, is that recessionary? Maybe, but that's what I'm interpreting from it, right?
I think when you add that to the fact that we have like the most open houses or had not houses that are for sale, the inventory is absolutely insane right now. We did a video on that last week. Yeah, I don't think it's good. I think it's bad.
Yeah. Yeah, personal income's still going up. People still are earning more.
Good.
So that's another nice thing to deal with this inflation and
Good.
hopefully maybe save a little bit. We never really saw like a wage price spiral in terms of inflation happening during this episode. And we've seen pretty consistent, income gains, particularly amongst the lower earning workers. But that trend continues through at least this past month. So we'll see where that continues to go. Um, now, this is the flip side, right? Because I think if all you got was this PCE report, and you were thinking about, all right, what is the Federal Reserve's next move? You'd be like, yeah, it's time to cut again, probably, right? They can certainly cut the Fed funds rate another 25 basis points after hearing this. I would think, wouldn't
I
you?
would agree. Yes.
Yeah, just purely in isolation. However, you have the economists here, like this Oliver Allen, senior economist at Pantheon Macroeconomics. He's like, I think PCE will peak later this year, and it'll be between 3 and 3.5%. So this person, I don't know them. I don't know their track record. Economists like broken clocks, right? A couple of times a day, maybe. Um, but they're calling for 1% to 1.5% increase in PCE inflation rates through like the next several months, right? Because I said second half of this year, we're almost effectively there. Filming this on May 31st, right? We're into June effectively.
So
It's crazy.
I I think that's only because of the next sentence. If
Mm-hmm.
the current mix of tariffs remains in place, which since this person said that, they have changed 4 times minimum, right?
Yes.
So I would take this with a grain of salt because already the premise that this was stated on has probably changed. The tariffs are,
Absolutely.
it is, like I said, we're one tweet from a 3% gain or a loss in a day just because of a tariff tweet. Like
Yeah.
it's just nonstop.
The only thing that's certain right now is uncertainty.
Yeah, for
All
sure.
right. Um,
Instability.
as far as the report itself, the trend over time here, like we talked about, we saw like a little bit of a peak here in February, where the 2.6%, but we've already come down 0.5% in the last couple months since then, back down to this 2.1% rate, which is a solid number. All right.
Yeah, that's
Hopefully
good.
that trend continues and we see core coming more in line with headline PCE. As far as categories itself, where spending increased, month over month basis here, housing and utilities, healthcare were the two top ones there, and then non-durable goods and financial services were on the lower end here, which is actually good. Financial services includes insurance, I believe, on this particular chart. So finally, insurance is not pushing up inflation like it had been for the last couple of years. We were talking about 15%
Just
yearly rates.
highway robbery, dude. Absolutely horrible robbery.
Hmm.
Just car insurance, housing insurance, terrible.
Yeah. Yeah,
Stupid.
I mean, it may be worth a separate video, but I see a day of reckoning has to come in that industry. It's just getting crazy. The price of insurance now.
Yeah. And not only that, not only are they crazy high, but they just stop insuring places where more things happen. So it's like, all right, well then why are you high?
Yeah,
You're
yeah.
eliminating the risk, but also increasing the price.
What risk are you insuring at that point?
Yeah.
All right. So this is a CME Fed Watch tool. This is what we're looking at as far as interest rate cuts for the rest of this year. Basically, the market right now is betting that September meeting is the first time we will actually get a cut out of the Federal Reserve.
Okay.
All right. There's a possibility we get one here in July, but they're saying that more likely than not, it's not going to be until September. And in this environment with the tariffs, I think that's right. I think if we didn't have this tariff uncertainty, we probably would see one at the next meeting, would be my bet.
So I'm going to make a bold claim here, which is, I mean, that's what you want to hear, right? We want to hear
Sure.
bold
Yeah,
claims that can then be held against us later. I-
absolutely.
If Trump makes a deal with China that they both agree is, well, not fair, but they both agree to, then I'm going to say it's July.
Okay. I
But
mean, sure.
that deal has to be there. If it's not, then I agree with September.
If that deal happens and the market rallies less than like 5%, I'd be shocked.
Yeah, but just China. I'm not talking about EU. I'm not talking about anyone else. I'm just China tariffs. As long as that negotiation happens, I would be shocked if we did not have one in July because that's really
Yeah.
the big one. Like
Caveat: a real deal, one that actually has teeth and is not like a superficial agreement to cooperate that actually has
no,
no
yeah,
real effect.
an agreement that they don't kill in a week, like a full on because they already had like a little agreement and then I don't know, it's changed
Yeah.
like 6 times. I can't keep up,
Yeah.
but like a full on agreement where like we're not touching this for 2 years, like that.
Yeah. Yeah. The PR wins is what they've had so far. And that's what I think they'll
Yeah.
continue to have. I don't foresee a real meaningful deal getting done, but maybe I'm just being a pessimist.
Now, I will say this is not directly correlated to bond yields. It does affect bond yields. And as of right now, this is destroying the housing market and is creating a lot of problems on housing inventories because houses have continuously gone up, but they can't afford the interest rate. People are you can't have these housing prices go up as high as they are and also have a high interest rate. No one can afford a home.
Yeah.
So
Yeah.
if that does not change soon, this is going to be a horrible situation. This is going to be bad.
All right. Looking for a separate bond yield, maybe housing video. I don't know.
Tomorrow.
Sounds like something we're worth doing.
Tomorrow. All right, guys. Let us know what you
Catch you
think.
next one.